2024 will be a critical year for US financial policies. Now, I don't mean the fiscal and monetary policies. What I mean is the policies that regulate financial sectors like banks, credit card issuer companies, asset management companies, and so on. Hi, I'm Jean, a researcher at dissect, so now let's take a look. Starting off with policymakers' main concerns regarding 2024's bank financial regulation initiatives like the Basel III Endgame, long-term debt, climate change, deposit insurance, as well as debit interchange. In particular, the Basel III Endgame, which is the Fed's top priority. The Basel III Endgame introduces extensive changes, especially in the calculations of risk-weighted assets. These alterations will significantly impact business models, compelling banks to reconsider their capital allocation strategies. Some of the more significant regulations is that regional banks above $100 billion in assets like JP Morgan, Bank of America, and Goldman Sachs are likely to face a rule requiring them to issue as much as $127 billion in new long-term debt by 2027 and is anticipated to be finalized by the third quarter of this year. You may think that this decision is due to the banking crisis that occurred last March. However, this rule was already on regulatory agendas even before the failures, which further emphasized its significance to the Fed. Another one of the Fed's top priority is the Basel III Endgame that stands to increase capital requirements by around 20% for the largest US banks, but it isn't guaranteed to be finalized in 2024. Though this rule is most likely going to be finalized, which stands to put $126 billion in excess capital at risk, we still have to be skeptical from a combination of legal threats and US election pressures that may push regulators to delay it until 2025. If finalized, a 3-year implementation period would start from July 1st, 2025. Higher capital requirement usually incentivized big banks to strategically work over the short run to gain loan market share, which they finance by cutting dividends, retaining more earnings, and issuing more equity. Once it gets finalized, US regional banks may have a problem in growing their profits. Several discussions in 2024 will focus on various measures pertaining to debit and credit card issuers, with one initiative posing a potential threat to the approximately $3.69 billion that banks generate through debit card interchange fees. The Fed's proposal involves reducing the existing cap from 21 cents plus 0.05% of the transaction, along with 1 cent for fraud prevention, to 14.4 cents plus 0.04% of the transaction and 1.3 cents for fraud prevention. It is anticipated that the finalization of this proposal will likely occur in the second half of the year. Fees are an integral part of the revenue generated by banks and financial services companies, so if it were to be lowered, it will cause a big blow to both parties. Another issue is regarding increasing credit card issuer competition, which is now dominated by Visa and MasterCard. This rule was initially proposed by Senator Dick Durbin. However, it is less likely to happen due to the lack of supporters and time as the election is coming very soon. And lastly, the concern of lowering credit card late fees. In early 2024, the Consumer Financial Protection Bureau is highly probable to conclude a regulation limiting late fees collected by credit card issuers. The existing cap of $30 is anticipated to be reduced to $8, posing a risk to approximately $9 billion in fees. Companies most vulnerable to this change include those with private label cards, such as Brit Financial and Synchrony. And now let's talk about the asset management industry. In recent years, private credit funds have flourished by satisfying the substantial financing demands arising from the post-COVID surge in private equity deals. Looking ahead, the implementation of these new bank regulations, such as the finalization of Basel III, is expected to further propel the trend of debanking towards private credit funds as banking institutions and financing less profitable. This shift is likely to private credit funds to extend their scope beyond leveraged finance, encompassing a broader spectrum of corporate lending and asset-backed finance. As a result of the expansion of private credit funds, this leads to systematic risk concerns for asset managers as they gain attention from the government. This could elevate regulatory burdens for hedge funds, private equity firms, large asset managers like BlackRock. However, regulators are currently in the preliminary phases of analyzing this situation, which includes an examination of increasing prominence of private credit in the United States. It is highly unlikely that any decisions will be reached before the 2024 elections, and furthermore, the possibility of a GOP presidential victory in November would eliminate any additional opportunities for further action in this regard. And lastly, a rather controversial topic, which is marijuana banking. This was a bill that was in discussion which aims to give the marijuana industry access to banking services. However, by passing this bill, it has two sides of a coin. If you look at the positive side, marijuana can be used for recreational or medical use, which by the way is legalized in 39 states of the US. However, without proper financial services access, the sector has struggled to scale. Therefore, by passing this bill, it can help make communities and small businesses safer by giving legal cannabis businesses access to traditional financial institutions, including bank accounts and small business loans. However, the categorization of marijuana as a Schedule I substance signifies no acknowledged medical utility and a significant risk of abuse, combined with federal prohibition, poses a threat to banking institutions. Ultimately, this bill will likely fail and will be reintroduced after the election. That marks the end of the video today. I hope this video helps you understand the upcoming financial policies better and something you can keep in mind when you were to invest in financial sectors. Thank you for tuning in and see you in the next one. Bye!